Welcome to the Broken Pie Chart Podcast, episode 265. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, Jay Pestrichelli, CEO of ZEGA Financial. Jay, what's going on?
Derek, another week, another new high was hit. I know you were paying attention.
I hadn't seen.
You didn't.
Wasn't aware.
I hadn't seen. Well, really? Another all-time high was hit. So, we touched again. Not every week has been up since the beginning of the year, but every week has seen. Actually, last week did not see an all-time high. So I don't know if we start the trend over again. But this market continues to be strong, fueled by optimism, I think mostly from the Fed, right? I mean, we had a Fed meeting this week. That was kind of a big deal. We got to hear Jay Powell talk. And,
it wasn't a big deal, though. I mean, it was a big deal, but it wasn't really a big deal to me.
The market liked it.
Well, sure.
Yeah.
Sure. I mean, let's talk about that. I mean, what really happened? And they came out with the dots. The dot plot, of course, is they asked the, right now, 19 board members in the Federal Reserve, and they ask them, hey, what's your projections for the end of 24, 25, 26, and then the longer run? And they did this in December. They did it in March. What changed? Okay, nothing as far as the expected Fed funds rate by the end of 2024, and I'm assuming it's the effective Fed funds rate, what the overnight rate actually is.
And
December
what's the number?
4.6 versus 4.6. So December to March, 4.6. I'll come back to that though, because I think some people have been mischaracterizing about how that could change. Core PCE inflation was 2.4. They jacked it up. Jacked up, not really a good term, but 2.6.
Right.
Unemployment, 4.1 to 4. Okay, lower unemployment. Change in real GDP, jacked it up, 1.4 to 2.1. Jay, better growth, lower unemployment, higher PCE core inflation, and right now about a 4.6, which would imply 3 cuts right now, if you're listening and believing the Fed, Jay.
Well, all right. So, and you'd say, why did the market like this so much, right? I think they added a new component that they discussed. Although according to this, that wouldn't be a problem. So one of the things that I believe was said when I was kind of reading through a little bit, I didn't get to watch the press conference live, but when I was reading through what was said was if unemployment started showing some weakness, they would be inclined to act sooner on lowering rates. So I think it's been a one-dimensional market for the Fed for a while, for the last 4 or 5 months, which was all about inflation. And as soon as they got inflation under control, would they? I think what's the term they used? They were confident that their outlook would be reached, which we just talked about here, right? Which is getting down to the 2+ range, just slightly higher than 2. Once they felt confident that was going to happen, they would start cutting rates. That's what they said. You and I have debated if that makes sense or not. So we don't, but that's okay. We don't even have to have that conversation here. But now they've added a second dimension, which is the unemployment rate. So if unemployment ticks up, they hinted they would act earlier. So now you've got 2 reasons for the Fed to cut rates. And I think that's what the market liked. The number of cuts hasn't really changed from the projection, as you just said, right? December projection was 4.6. The current is 4.6. But I think they gave more of a second reason for them to go. By the way, I am not in the 3 range, in case you were asking. I was in the 1, and now maybe I'm at the 2 because they added the second dimension here. I could be wrong. I'm probably going to be wrong about that. But again, the 3 seems still unnecessary. The economy's hot. You just said they changed their GDP projection from 1.4% to 2.1. That means growth. If I'm thinking about it, and why would they cut into a growing market? So I think that to me is the market like there's another reason for it to cut. But again, it's bad news, good news for the market kind of a deal. And we never like the bizarro land because that can unwind pretty quickly. But we've been in bizarro for a while.
I wonder if when they do their dot plots, are they saying, I think it's going to be core PCE of 2.6. And that includes my projection as well of where I think we'll be with interest rates. Because if I look at this, why do they cut at all? There's no reason to cut. If there's growth, unemployment's low.
I know, and you and I have said that. Like, I don't think they won't have a reason to really cut, but maybe unemployment, Derek. If that ticks to like 5, maybe they'll do something and not find themselves to be too slow on that.
I didn't do it this episode. Maybe in a future one, I'll pull up the old dot plots from like 2014, and you see the Fed is never right on their long run. You know, they're 1 or 2 year out or 3 year out.
Sometimes I feel it's more like wishful thinking. Like, hey, if we got everything right, here's where we'd like to be, versus actually what's happening. It's the wishful thinking plot.
How much thought do you think they put into this? Do you think like they're walking out of Starbucks and Jay Powell comes up with a clipboard and says to some of the other members, "Hey, what do you think? Hey, I need an answer. I don't know, 4-6, 4-6."
I think they're more thoughtful than that. I know you were joking, but
yes.
I also think they're not held accountable for it, and so there's probably less diligence and scrutiny there. I mean, this is their job, right? They are arguably some of the smartest bankers in the country, and they stay in touch with businesses. Like, they do their diligence. They go and they talk to the businesses in their districts. I know this. Actually, one time, I think I told you this, we did a seminar in North Carolina one time, and one of the advisors knew someone that worked at the Fed, and so we had a long conversation afterwards and things like that around like, how do you guys really get a feel? And they literally will talk to the businesses that they have relationships with, right? How's it going? What's your growth look like? What do your sales look like? It's all voluntary information, of course, but they try to stay connected. So I think they give it a shot. I think they try. They're not held accountable to it. Really, ultimately, what the rate is what the rate is. So I would say it's not random. I'll give them all the fairness. I know you were being.
Yeah, well, I love joking about the Fed, and so the other thing I would just address is I heard a lot of talk on CNBC. They were one member away from in their interest rate, their Fed funds end of year prediction, or what their best guess is. They're one member away from only having 2 cuts, and all right. So here's the deal: a median. Basically, if you're looking at median, the formula for that, I'm not going to get too technical, is N, and N is the number of occurrences. So we have 19 people giving dot plot projections. And then it's N plus 1. So N plus 19 plus 1 is 20, divided by 2 is 10. So if I have a list of 19, it's your 10th person that is the median. And the median right now is 4.625 is the median end of year Fed funds. Now, let's say that somebody and the top 2 were 5 3/8 is their end of year effective Fed funds. The third and fourth was 5 1/8. If numbers 3 and 4 jacked up their rate to 5 3/8, the median would still be the same. If the 19th member is only at 4 3/8 and there's only 1, moved it up, wouldn't make a difference. You'd need one of the people at the median, 4.625. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9. Like 9 of them, I think, just eyeballing it.
Yep. 9.
So that's what I mean. Like, if you change some of these numbers around, they weren't just one person away. They were certain people. If they moved it up, then the median would go up. And the way that this works, if the median is 4.625, that falls right in between 4.5 to 4 3/4, which would be 3 cuts down from 5 1/4, 5.5.
But there's plenty here that are projecting less by 1. Really, it is really 1. Like, if that number 10 person, right? If the 10th person projected 2 instead of 3, the median would be 2. So it is kind of close, but not that if just one of them, right? You can't use the average math doesn't work, and you're right. It was portrayed strangely, through certain media stations. I got you.
I mean, it's basic stuff. It's median. I just gave you the formula. I mean, it's
middle. Who's the middle guy? There you go.
Yeah. By the way, if we had 20, somebody at home is like, wait, so 19 plus 1 is 20 divided by 2, so that's 10. What if we had 20 people? Okay, that's 21. Divide 21 by 2, That's 10.5. Then you actually use two values to the average of those two values to get your median. If it's but enough about
And that
median.
concludes your statistics portion of
class closed. What's not closed though, Jay, is the yield curve inversion. Congratulations, yield curve inversion. You've done it. Yield curve has been inverted for 18 consecutive months. That's a new record, exceeding by 1 month now, March of 1980. Means something, or does this mean nothing?
So far, it's meant nothing.
Yeah.
So far, it's right. So this is why do we talk about this? This has been that data point that plenty of fundamental and fixed income analysts will say is when you have an inversion, you are less than 18 months away from a recession, right? That has been that's been the history here. And when you look at the history, sure, it seems to work out most times like that. Sometimes you might be in a recession already. Sometimes it's, like we said, 18 months ahead of time. It feels like an eternity at this point. But so far, and you take all the data that we just saw with GDP and unemployment, I mean, I don't know, doesn't look like that's any time around the corner. Of course, anything can change those things. But this is why we care, is because historically, fundamental analysts will say you're gonna have a recession after this. I think the market would tell you something very different than this. And this, we are living in kind of a unique period when it comes to rates, and the Fed itself is saying rates will come down. Now, I don't know. Right. So we've talked about a lot of ways that this will look when rates do come down and how this curve uninverts. Right. Does the long end of the curve go over the short end? Does the short end come down to get below where the long end? Is it a little bit of both? It's probably that. So, we will have to find our happy medium, right? The stability period. But for now, I think this is going to continue for a while.
I mean, it's going to continue until the Fed doesn't. I mean, remember, they invert the curves. This doesn't necessarily happen naturally. I mean, I'm looking at all these dates, and our audience can't see it, and I'm just looking at these, and I'm thinking, when does this actually happen naturally? It doesn't. Like, the Fed moves rates higher, the short end of the curve, they move it higher, and they invert it.
Remind me that 2019, right? Leading into the pandemic, right? Nobody knew the pandemic was happening in September of 2019. But that period lasted 5 months, right? And that was one of those times that, I would say coincidentally preceded a recession.
But the Fed did that. My point is the Fed did that, Jay. I mean, it didn't happen with the natural rate of interest.
Rates in September in 2019
I believe they did.
Yeah.
Fed interest.
Can't believe I can't remember, but yeah, there we go.
I'm looking at it right now, Jay. 2019, because now I'm curious looking at
because I felt like that kind of naturally happened a little bit on its own. I remember there was everything going on in 2018, Q4, Fed was projecting a recession, and they were thinking, right? And they caused that 19.6% sell-off in Q4 of 2018. But I don't remember in Q3 of 2019 them cutting and causing the inversion.
Well, remember that they raised it. Let me see. It was at December 20th of 2018. The Fed funds rate was 2.25%, 2.5%, and they lowered it by August 1st of 2019. They lowered 25 basis points to 2.25%, and they kept lowering. So they lowered it eventually by October 31st, 2019 to 1.5%.
Lowering typically wouldn't invert the curve, but
it would uninvert it, and that's what happened. Yeah, I mean, it if you look at a few months later. So my point is that they were 15, 16, 17, 18. They were raising rates. And you remember we were in one of our investment committee calls that we normally have every week. And I remember being on the call with you and the other members. And when the Fed raised rates, they said they just inverted the curve.
Yep.
And they just inverted it. Like,
I remember.
And the market tanked. Market almost sold off 20%. So
yes, I remember the 18 time period for sure. All right. So look, the point here that we're kind of getting back to is the curve has been inverted for this is the longest it's ever been inverted, and we'll see. Thank you, Jeffrey Weniger. Is that who put this together?
Yeah, from Bloomberg.
Yeah.
Is that Bloomberg? I think so. Maybe not.
Yeah. Well, thank you. So and it seems like it's going to continue until the Fed acts. Right?
Refinitiv is who the credit is on this one. So, all right, let's every week we sort of decide, do we want to scare people, or let's not scare people this week. Let's go the opposite. And I say this for anyone new listening, we joke about this because if you watch the media sometimes, they're either going to scare you, or usually they try and scare you. It's better for ratings. Or they come in, they tell you everything's great. So like we buy, we hedge, we buffer. I mean, that's the core thing we do. So, we don't try and predict markets, but we like to talk about them. And one of the things I would say that was when you watch, let's say CNBC over the last couple of years, the debt maturity wall, Jay, is coming. And what that means is all these companies who financed at low rates, they're in trouble because I'm smiling and using air quotes. They're in trouble because they're going to have to roll their debt, meaning they financed, 5 years, and these are high yield companies, so junk bonds, high yield and senior loans. So that's going to come due. And when they have to roll that debt forward, it's not going to be at 5%, it's going to be at 8.5% or 9%. Well, this was a Bank of America chart. I saw, I think this was Tracy Alloway and Bloomberg had put this, forwarded this out on Twitter. She said, this chart, debt maturities by year. So our audience can't see this, but basically to set this up, 1 year ago, how much high yield debt was coming due at the end of 24, 25, 26, 27, 28, and so on and so forth. And what we've seen is now, updated a year later, the debt maturity wall has been pushed out, meaning there's not really that much in 2024 anymore. There's not as much in 25, it starts to be higher, 26, 27, 28. But this debt maturity wall seems like it's been pushed out a little bit, Jay.
Yeah, and the reason we care about this, like you just said, is the high yield will cost more, be harder for companies to meet their obligation with higher rates, right? We all know this, right? You have a mortgage at 3% or a mortgage at 8%. Obviously, it will cost you more to service your debt at 8%. And so this is very positive that in the, kind of the short term, this has, looks like they're dealing with it proactively, right? Looks like everybody understands this. And I guess there's a couple ways you could come off of this list, right? Like if you had debt that was due, 2026 and now you don't, what could you do? I guess you could have, like you said, you could have already rolled it out to a different maturity. You could have, You could have, gone from high yield to investment grade, gets you off this list, right? So your company could have appreciated. What else? I guess you could have defaulted and gone out of business, gets you off this list as well. But this general trend here in the short term that they have pushed out, when the maturities are, is generally a good thing and should at least remove some of the fear about high yield. High yield has this interesting, not everybody watches it, but the spreads between treasuries and high yield are one of those things that kind of tell us if we should be, if the market is fearful, right? If the market is worried that fundamentally the companies issuing their high yield debt cannot maintain it, and then that debt, the value of those bonds goes down, the rate goes up, and the difference between the interest rate of the treasury and the high yield is kind of this implied indicator of fear in the market and fear of defaults. I would say generally defaults are considered bad right there. It doesn't mean you went out of business if you default though, but defaults generally are bad. You're not meeting your obligation. Your business isn't strong enough to handle what you committed to. So I think the fact that there will be a little less pressure in the next, 1, 2, 3 years, I think less. So this would my quick math says 15 to 20% have to have debt maturities in the next 3 years. That's fairly low, right? So it doesn't mean you can't default, but it just means you have more time before you have to refinance and incur a higher rate going forward.
I would tell you too that I'm looking. This doesn't include senior loans. So you think about the two different sides of this. You have high yield or junk debt, which is just below investment grade, or you have senior loans, which generally have priority over just bonds. They're senior, meaning they have a claim to the assets of the company. And those typically are high yield type companies. But if I look at the size of the U.S. corporate high yield index, Jay, it's sort of crested at the end of 21 into 22, and now it's more like 2018 levels, I would say. But you're right. I mean, you can default, you can pay it down, you can roll it out, or you graduate. You got a better credit rating and you go up. Or it could just be a function of there's not as many issuers who are coming to the high yield market. That's another thing. I don't have the size of the senior loan market though, but that's, I will say, Jay, I talked to our friends over at State Street this week, and they point out, the spread, to your point of the high yield spreads and the indications that give us, spreads are really tight right now. I mean, the as you explained it. So, but it doesn't mean, spreads can stay tight in for a while.
Yeah, it's okay, but it's a good sign. It's if they were really wide, it would be another data point like the inverted curve that goes, the bond market's kind of concerned, but it's not the case. So, like you said, not scaring anybody talking about high yield spreads.
No, the also a lot of the days we've had these sell-offs, you and I have commented to each other and among our investment committee as well. When you look at the equity markets are selling off, but high yield has not at the same time. One of them is wrong. And so far, the dips have been bought in the equities. But high yield, a lot of these dips, the recent, when I say dips, it's not like nothing, right? I mean, like you said, we haven't had a greater than 2% pullback, I think, in a while. But on days when the market's down, high yield is not reacting the same way. And that's sort of been a good sign because the high yield market's like, no, this is okay. This is going to be a buying opportunity.
And I always feel like the high yield market is a little less reactive.
Yes.
Right? It's not as schizo as the equity market can be. A little more measured. A little more measured.
So let's turn to the equity market. And so there's a couple things. We've heard we've come too far, too fast. 23 was too high of a return. Too much. We're due for pick from the list. We're due for a crash, a 1929 depression. We're due for a pullback. We're going to tread water for a while, or I haven't heard Tom Lee, but I'm going to assume that Tom Lee is still upping his targets even more. Tom's been the bull in a sea of bears for a while, so I give him credit for being convicted on that. But 94, 95, Jay. Going to keep coming back here because 94, the Fed starts raising rates. They stopped raising rates in 95. And if you look at the equity markets, 1995 plus 37.2. This is the S&P. 96 plus 22.68. 97 plus 33.10. Pretty good. Oh, yeah, it keeps going. 98 plus 28.34. 99 plus 20.89. And then 2000 minus 9, 2001 minus 11.85, 2002 I think was down 2. I don't have it on my little graph here. And just to set the picture before you come in on this, Jay, the 3-month T-bill, I don't have what the Fed funds rate is, but the end of 93, it was 3%. So this is kind of your risk-free rate. 94, 4.25, 95, 5.5, 96, 5, 97, 5, a little over 5, 98, 4.78. Okay, I bring this up because just because the market's up 1 year a lot doesn't mean it can't go up again. And interest rates were high. They came down and the Fed stopped raising. But this is what I've been saying, like the Fed just has to stop raising. And equity markets generally like this. But just because markets go up doesn't mean they can't go up more.
Yeah, I mean, wouldn't it be great if, 2023 was the first year of a run like this from 95 to 99?
Absolutely.
I mean, this 1, 2, 3, 4, 5 years in a row over 20%. That'd be great. That'd be great for a lot of folks. So, yeah, I mean, and like you said, it happened in an environment where the 3-month T-bill was, around 5, kind of like what we have now. And you're right. It seems that, in a vacuum, when you look at this data, it seems that, hey, as soon as rates started coming down a little bit, that was it. The equity market took off. And we've always talked about this, right? Lower rates Wind in our sails kind of a thing. It's one of those things that drives market direction. So, and the market has been certainly reacting to that. I'm going to say something, you may disagree here, but to me, it seems more likely rates are lower by the end of the year than higher or the same. And even though I'm in the 1, maybe 2 camp, it's still going in the right direction, right? And if they could make it last for a while and we don't run into a recession through all of this where you start to have job problems or you start to have a drop in corporate earnings, you're right. This is, we are set up for a fairly robust run. But rates probably lower by the end of this year. The Fed would tell you they are. I think you're on the fence of, they don't have to be, but I say slightly, and slightly is probably better because it means you didn't have a reason to lower, right? We've talked about this multiple times. Like, we really don't want them to be forced to lower because something's going wrong if that happens. They can take their time here.
Right. And that's exactly right, because those who are like, hey, I really want to see 3 to 5 cuts, like let's go down to 3. Okay, that means your friend lost your job, you lost your job, growth is non-existent, your housing price is going down, the market is not doing well. Great, let's have all that happen so we can get down to 2.5% Fed funds rate. Like, that's not constructive. So ideally, you have good growth. And for those who think that, hey, if we can get the Fed target, we can get inflation on a year-over-year basis back down to 2%, Fed funds has to be 2%. That's not the case. That is not the case at all. In fact, to get a real return on your bond, like your bond yield should be higher than inflation.
And inflation, right.
So
but I think they've said, right, the average you should shoot for, I think the Fed should be in the, 1.5% to 2%, right, over inflation.
Yeah. I also see too, so you look here, so BAA, that's triple, I always bring it back to the S&P one because it's a little easier to, so BAA1, is that BAA? Yeah, that's what, triple B plus. So that's investment grade, but the lowest rung of investment grade.
Level of investment grade, yeah.
I mean, the spread between what the S&P returned and what the triple B plus bond returned, I mean, actually, bonds did pretty well too, to be honest with you there.
Yeah, it was a great time. I mean, they didn't have as many years of plus 20%, but there's double digits.
Yeah, it was like plus 7.6, plus 9.3, plus 8.5. There was a 21.29 and 95. That's to be expected because they started to cut rates by, I think, May or September of that year. I think September.
So what do you say? You're saying we should buy corporate bonds now if we expect rates going down? Is that the one?
No, I'm not saying that. I mean,
because I would say that I would not support that.
Not necessarily. Yeah. I mean, I think, let's not go to the bond side of that.
Oof, so that's the dark side for us.
Yeah. I guess
we talk about it all the time.
We run a quant strategy as well called 4 Seasons. And we're looking at option data. We're looking at volatility levels. We're looking at where the market was and then where it goes 10 days later, 30 days later, 60 days later. I did a quick thing, Jay, and I know you look at this all the time as well. The other thing I'm hearing is along the lines of, well, we said it before, the too far, too fast. The market's gone up too far in a short amount of time. And I don't know. I mean, I pulled some of this data. I sent it over to you. You've been looking at it as well. We haven't spent a lot of time with it. But just eyeballing it, Jay, it seems like just because the market's up a lot in a short amount of time doesn't mean it's going to be down a lot in the next short amount of time. Like, it's sort of markets in motion stay in motion.
Yeah, I mean, just because so there's 2 data points I'll add on to what the study that you just did here that shows that you can have these consecutive periods of positive returns kind of continue to add on. The first thing we'll say is over 36% of the time the market is within, this is back to 1950, is within 3% of an all-time high. So that means it could be making a new one or had a pullback of less than 3%. So a third of the time the market is pressing higher. Some years, multiple years, like this one, the market 100% of the time has been within 3% of an all-time high, right? This whole year we've been within 3% of an all-time high because we keep making new highs. The other data point I'll reference is a data point you provided for a webcast that we did with clients and advisors, which said 12 months after an all-time high is made, on average, the market is 14% higher. So higher highs beget more highs going forward. They can create highs. Of course, all pullbacks start after a high, right? But if you look at where we are today, typically markets continue to come back. And so if you have the time, staying invested in the market is great. We're generally bullish because of this. Naturally, we don't know when the sell-off will start. I think when you look at the high yield spreads, when you look at what the VIX is telling us, right, there's not a lot of, flashing red right now that we see, but you never know. Nobody saw flashing red in January of 2020 either. So it's one of those things you don't know when you can have this market event. So if your time horizon is, if you don't have 20 years to go, we like to offset some of that risk and hedge, but still stay bullish because we want to continue to provide growth in an upward moving market. So for us, that's our broad-based philosophy. I think if the more time you have, the more, you like to be in the markets because generally they work in your favor. Generally. 2022, not so much. Be a while before we forget that one.
But over the long term, this gets back to how much time people have to be in the market. And we know the longer they're in the market, the better off it is. But when you look at long-term charts, I think sometimes it's a lot of investors would be better off if they didn't watch the news, didn't read the paper. Like, let the market do what it does. And in the long run, we hedge because, we don't want to take like a 40%, 50% hit. If you can avoid that, your, path back to break even is much easier. But yeah, markets 2022 will wind up being a blip in the long run.
Yeah, no, that's true. And we've said this before, so this is not new. The dirty little secret, it's not even dirty. The secret about our business is, not until you have sizable assets do you need folks like us to help you plan, right? For when you need money and how to create diversification. If you are in those early accumulation phases, buy an index-based ETF and just keep adding to it. Don't even worry about timing it. You don't have to sell at the high. You don't try to pick lows. You'll get that wrong more often than you'll get it right. And just getting it wrong a few times can be pretty detrimental. So, it's one of those things. Just, I tell folks that are just starting out investing and they say, Jay, what should I do? And I say, buy the S&P, buy the Qs, just keep adding to those going forward. Once you get to a sizable amount, typically we're what, Derek? Like, it all depends where you live and what your plans are. But these days, once you cross that $500,000 mark, it starts to make sense to break up those assets and figure out how you want to create the diversification. But if you're young and you have years, that's what you buy. You don't need guys like us at that point, right? Because guess what? We're probably going to do the same thing for you anyway. No reason to pay us for that.
Well, they need to keep listening because we'll keep reminding people about this rather than buying.
Listening, I'm not saying don't do your research, of course, but the answer is easy, right?
Yeah.
It can be very easy. Of course, listening and reading, like a wonderful book, like The Broken Pie Chart.
Or
on Amazon.
Or Buy and Hedge.
Yeah.
Or a forthcoming book that we'll write someday.
Yeah.
We got to title it and start selling it. That's what we'll do. All right.
Okay. All right.
Don't buy Bolivian crypto, I don't know, coins or something like that.
You're going to open the crypto door again? I'm going to tell you, I have had some comments from our listeners about our crypto dialogue over the last 2 weeks.
What are they saying?
Well, some of them say, keep giving it to Derek and reminding him that this is not a flash in the pan. And some of them are absolutely in your camp and say, I don't know, I can't touch this thing. There's no fundamental basis behind it. I'm not sure I believe it exists. It's real. So definitely getting mixed feedback. So I love it. I like that we're getting people thinking about it.
Well, all right. You brought it up or I brought it up and let's talk about it. There's something called Bitcoin halving, Jay.
Yes.
What is this?
So, all right. So look, I will. So look, even though I'm aware of a lot of things that go on Bitcoin, I don't always know all the little details. And so I really, in advance of today, wanted to get smart about this halving, which is coming. By the way, when I hear the halving or the halvening, either way is what you could call it. It reminds me of an older movie.
Highlander.
Highlander, The Quickening, right?
Yes.
That's exactly what it reminds me of. Highlander.
Yep.
I also think, I'm totally off base on this, on something else. I also think the greatest villain of any movie was the Kurgan from that movie. That actor has done so many other things. He was the voice of Mr. Krabs. He's been in Billions. But he plays the Kurgan. He's such a good bad guy. So if you want a good bad guy, try to get it's got to be from the 80s.
It's Clancy Brown.
Yeah, it's Clancy Brown. Yeah, he's great.
1986 Highlander. By the way, he was in Bad Boys, opposite Sean Penn. When Sean Penn goes into juvenile prison. Great. It's kind of a lost movie. It's never on anymore.
No, yeah, nobody ever talks about it.
He was the guard in Shawshank Redemption.
Yep, he was the main guard. Like, so many things he's been in, right? So, all right. But back to the halving. So essentially, it's a planned reduction in the rewards that miners get for processing the code on the blockchain. So what do I mean by the reward that they get? So when Bitcoin first launched in 2009, miners would receive 50 Bitcoin per block that they would produce. So remember, mining just means you're solving the complicated equations that allow you to create the secure blocks within the blockchain, right? So if you completed a full block back in 2009, you would have got 50 Bitcoin. Well, what happens is every 210,000 blocks that are created, the amount you get gets cut in half. So the first reduction happened in 2012, right? So you went from getting 50 Bitcoin to 25 Bitcoin. So this is how miners, by the way, earn the Bitcoins, right? They actually produce something. They support the blockchain. They do the computations that produce the blocks of the blockchain. And so in 2012, it went down to 25. In 2016, it went to 12 and a half. Then in 2020, it's not so far ago, they got 6.25 tokens. Well, now it's estimated that this next block of 210,000 will be completed sometime in April. And now miners will get 3 coins, 3.125 coins, sometime around April. So the idea behind this happening is that, because of the amount of Bitcoin that's out there, this is a way it kind of fights self-inflation. It lowers the amount of coins that will be paid. And by the way, I think maybe you don't know this, Derek. You do. Maybe not everybody knows. There is a limit to the number of Bitcoins that can ever be created. This is different than other crypto coins and other crypto tokens. But there is a limit. There can only be 21 million Bitcoins ever in circulation. That's after, by the way, the 64th halving, I believe. So we got a long way to go before we get to that point, and it gets harder and harder, and you get paid less and less to mine the Bitcoins. So that's what the halving is. That's what's happening, where the miners get paid half of what they used to get paid to go mine Bitcoins. And so the result of this is that miners just have to get more and more efficient, right? They have to use better chips. They have to be more, cost efficient. All of those things on ways of mining the coin, because they're going to get paid half of what they got paid, what they're getting paid today. So go ahead.
So, all right, I have 2 comments on this. One is I'm talking about yield. So if you're an oil miner, is that the right way?
Driller? How about driller?
Driller. Yeah. So let's say that for every 1 hour of labor or 1 unit of labor, you're now producing half, which means your profit margins go down, which means you might have to, so in theory, this could get some people out of the business. I'm making this up now. I have no idea. But in theory, in economics, you would say, well, does supply come down because it's cost effective? Or does this all point to NVIDIA, Jay? Picks and shovels to the moon, NVIDIA. I don't know.
Yes. Well, the chips are definitely a big piece of this, and supporting that and coming up with more efficient chips, more energy efficient, faster chips. All of that will really matter to the actual miners. But the concept, And maybe I'm going to ask you to put your Professor Derek hat on for a moment here, because we're going to talk about supply and demand and cost. So in the few times that it has had this halving, right, Bitcoin has shown significant price improvement. Now, I'm not sure if we already experienced it, because we've had quite the run, right, from 15,000 to 70,000 recently, and the price per Bitcoin. But in 2012, Bitcoin, remember, nobody even knew what Bitcoin was in 2012, right? It gained 8,000% in the next 12 months. But more realistically, and maybe this isn't even realistically, in 2016, it rose 1,000% after the last halving. So the one in 2020 was also followed by a nice bull run that ended in, at 68, 69,000. I don't have the percentage higher that went, but still, this is one of those things that, is it because, there will be a little less out there because less miners, they're less incented to go mine, that it could be supply and demand piece pushing the price of Bitcoin higher?
I mean, all right, let me just I'll cover up the name of Bitcoin and just think of any commodity. And there's sort of the sarcastic way of saying the cure for high prices is high prices, the cure for low prices is low prices, meaning, but we also could substitute price for profit margin. And so if it's halving and all of these miners, and I don't pretend to even understand all of this, but of all these miners, now their yield is half as much, so their quote unquote margins are going down. So what you would say economically is, if margins go down, you would think that it would cut down on the new entrants to the business. It would cut down on the existing, people in the business. And it's kind of like, if there's really, really big margins, people go to that area of the economy. And then eventually, as margins get cut, as margins go to zero, people leave the business, and then it sets into a long run sort of equilibrium where, so yeah, I mean, I think that's your question, Jay. I mean, in theory, it could decrease supply, decrease the incentive, and decrease the number of participants that are doing this. So yeah, and I'm saying this like I don't even understand the whole. I get it. They're mining it and they do equations and all that stuff, and it costs energy and it costs computing power.
Right.
But on an economic standpoint, that's in theory what you would say. It's like blue ocean doesn't stay blue ocean forever.
Yeah, I mean, if you're using, let's say you're doing steel or a textile plant, right? If all of a sudden the amount you get paid for each ton of steel that you produced, let's just picture it that way, like you were forced to deal with a lower price for your production, or what you received, would your steel be worth more or less later, right? That's kind of maybe that's an equivalent that you could use with standard industry versus what's going on with mining and efficiencies and chips.
Yeah. I don't know.
Yeah, I don't know either. And I think obviously Bitcoin has had a very strong run recently, and maybe it just got ahead of itself, and it's already baked in. There's been obviously some big news events that have happened this year to the positive, with the fact that the SEC allows ETFs now to hold spot Bitcoin. Before you had to hold the futures and you had to be kind of tied to a derivative product. Now they allow ETFs to hold spot Bitcoin. That did, there was a lot of buildup up to that, but then even after that, it followed through and still went slightly higher. That was that January when all that happened. So, look, I don't know. There seems to be some positive news on it this year. I'm definitely not telling anybody buy Bitcoin. Don't go at it. If you have it, maybe you'll be happy about it when it price changes. Do I think it'll ever be lower than where it is right now? Yeah, I think there's a good chance that it could be lower than this. Do I think it could go higher too? Sure, it could go higher. But it's just such an interesting, investment. I'm not going to call it an asset class. You kind of it seems to be the thing that catches a lot of folks' eyes, and it's certainly continuing to be interesting. I do think it is my last comment on this. I do think is really beginning to bleed into the equity markets themselves, meaning, there's quite a bit of companies that now have Bitcoin on their balance sheet, right? That, the change in Bitcoin changes the price of their stock. We talked a lot about Michael Saylor in the past and MicroStrategies, but there are many others that have this as well. Nobody as big as MicroStrategies, but Galaxy, Marathon, even Tesla has $500,000 in Bitcoin on their balance sheet, right? Coinbase, clearly. And these are publicly traded companies, and they can affect the index. So the index is. So I do think it is finding its way into the market. And so when you own an index, you own some exposure to this. And I do think it's been one of those things that's pushed the market higher. And then your picks and shovels analogy, Derek, whether it's AI or crypto that is causing this pretty dramatic run in semiconductors also seems to be. So if you're in the markets, you have some exposure to this. You're not completely absent of having exposure, which is, again, why we like to invest in the indexes. You kind of get a piece of everything that's going on.
The problem with Bitcoin is it's not proven itself to be an inflation hedge. It's not proven itself to be a hedge against down equity markets. This tends to do better when it's a risk-on environment. And
agreed.
The froth, I would say, in the Bitcoin price, and I have no idea where this is going. Clearly, I've been wrong about I think it should be zero, to be honest with you. I say that, because it's something if you're buying Bitcoin, you're buying it because you think you can sell it to somebody else at a higher price later. You think it will maintain value. And it's much like, I say, Topps baseball cards from the 80s. If you own something, it doesn't produce cash flows, doesn't produce a dividend. People don't necessarily need Bitcoins to do anything. You don't need Bitcoins. There's no use for them.
But is it a tulip bulb? That's the ultimate question.
It could be.
I'm referencing the correct me on the details here. The Dutch
tulips.
The Dutch tulip bulb. And if you want to see a fun example of it, I think it was the second Wall Street movie, right? Where he's Michael Douglas's character, Gordon Gekko, has a poster of the price of tulip bulbs just to kind of show what a bubble really looks like. So is it a bubble or not? We shall see.
I can't remember the book. There's A Devil Takes the Hindmost is a great book that talks about bubbles. There's a quick recommendation, Jay.
Okay.
That and the South Seas China bubble, the tulip bubble. The nice thing about bubbles is you'll know when there was a bubble. Like, I think a lot of money's been lost trying to pick when the next bubble is. And people could be right, they'd be wrong on timing. Edward Chancellor, Devil Take the Hindmost, Hindmost. All right. How did I allow this Bitcoin talk 2 weeks in a row? I don't know.
I'm really getting in there. I'm getting in there with you. I promise I won't bring up a topic next week unless we have to.
Oh, if I can find negative stuff on Bitcoin, I'll bring it up.
Great.
That's my rule.
Strange you haven't found that yet, but keep looking. Oh boy. I'm sure there's plenty. Now that I've given you a challenge, I'm sure I'll receive 10.
Well, number go up. The book by Zeke Fox, Faux. I think it's Fox, is a good book. And I think it was a really good book about the world of Bitcoin. And one of the things, he was very negative on is the whole, remember you took a picture of something and then you put it up as an NFT. What a scam that was.
Yeah. The digital art, and you got the only copies. Like, yeah. Okay. Now with AI, I could draw pretty much anything that I like. Have you used the drawing tools, the picture tools yet? The picture AI? It's pretty great.
Yeah.
I am becoming more and more enamored with our content creation being assisted through AI. So I would not be surprised, Derek, if some of our blog may be informed by AI just to keep things moving a little faster. You never know.
Yeah, I guess the problem so far is that I don't remember who said this, but you take something you know a lot about, and you look and you search for information about it, and to see how wrong some of the information is. And thus far, with market data, and ChatGPT doesn't update their market data to, I think they're always a little bit behind. But Google Bard or Gemini, whatever the heck they're calling it now, like you ask it market data, and I'm like, this is wrong. Even something as simple as, what's the top 50 companies in, US companies, and they have foreign companies in there.
Yeah, I'm not sure if you're using it though the way it's designed. It's not a search engine. AI.
I know,
Right.
but there's wrong information.
It creates content, right? It helps you create content. And so,
yeah,
if you were to use it for something like, hey, write me an investor letter that explains why staying invested in the market and higher highs are not a bad thing, I think you'd see some interesting, content without technical specifics and those kinds of things. So I think it's very helpful there. I had it just for the heck of it, Derek. I tested it and said, write me a presentation for ZEGA's buy and hedge retirement strategy. And it gave me an 11-slide presentation that, without any real specifics in it, did hit the content topics that I would have included. And then, you fill in the gaps with your own, risk graphs and your own data, our whole 10%, reinvesting while the market's low, hedging opportunity, all those kinds of things. But it has been, I definitely have been impressed with its usefulness in assisting with content creation. But you're right, you can't just use it and then fire it off. I know one of our listeners has used ChatGPT to, write a video script for his company, right? Like, hey, write me a 2-minute video script talking about, this topic. And so I definitely know that it is fun. Look, I think it's saving me a little time. But it's right now, it's more novel than anything else.
I will tell you that, myself and a co-author, Liam Sanford, wrote a book called Effortless Public Speaking, also available on Amazon. And he has a website, and he puts out a newsletter. And one of the things that he's done is he can take one of our chapters and put it into ChatGPT and basically write through prompting, the right types of prompts, turn a chapter into tons of content, turn into a newsletter, turn into a Twitter post, turn into, a short form article and stuff like that. So it's pretty interesting what you can do with that.
Yep. It will definitely be, it's finding out the right uses for it. Right now, I think, like I said, it's still kind of a novelty for most folks. So,
all right, recommendations, Jay. What do you got?
I told everybody last week I'd watch Shogun. I'm watching it. Absolutely watch it. It is good. If you have Hulu, I did watch. Oh my gosh, the detective show on HBO with Jodie Foster, True Detective.
True Detective.
Yep.
Yeah, I liked it.
It was good. I would say episode 1 was good, got you really hooked. 2 and 3 were a little menza. 4 started building. 5 was good. 6 was great. So it's only 6 episodes. I'm supporting your recommendation of True Detective.
Yeah, no, I agree. And it was a little more, would you say, supernatural to it?
I mean, there's always this little, I don't want to say spiritual. I'm going to say that there's something, supernatural associated in there. And turns out that it ends up, things all make sense at the end of it all, but you never know which way this is going to go. Right.
Yeah.
That was good. It was nice. It reminded me a little cultish of the very first one, right? There was that it had a little cultish feel. This a little bit of, there's no cult in this, don't get me wrong, but I don't want to ruin it for you. But yeah, it's not just a straight up mystery. It's good. The ending was good. I did not see the ending going the way that it went. So that was nice.
No, I thought it was great. By the way, did you catch that McConaughey's character in the first one? I believe his father is mentioned. I don't want to ruin it, but his father is mentioned in the Jodie Foster one, the one you just watched.
Oh, really? No, I didn't catch that.
Yeah, I'll tell you off air what it was.
How about you? What do you got?
I watched Oppenheimer finally.
Okay, what'd you think?
I thought it was really good. It wasn't what I expected, and I was disappointed. I never got to see it in the Max Theater or anything like that. I just never went to go see it. But you didn't really need to see it. Like visually, there was some good stuff, but it was less about the visual and more about the dialogue.
Yeah, I agree. It was more of a biography of Oppenheimer than the story of, the bomb that defined him. But there was a lot more around that. I didn't realize all the social stuff that he was involved with. So it was a biography.
I thought it was really good. And the cast, people kept showing up. I'm like, oh yeah, that person's in it too.
Yeah, no, great cast. I mean, I think it's, it's got a whole bunch of nominations and stuff like that. We'll see. I think it was overhyped. in my opinion. I definitely did not need to go see it in IMAX. I did. I made the trip to an IMAX theater and didn't need to see it that way.
Christopher Nolan's a great director, though, and he has that backing music that creates, like, it keeps you on the edge of your seat. Even if two people could be walking to go to a Starbucks and that backing track is on, and it's like,
he's an incredible director. I think some of my favorite movies are his. Right, so he produced. Is Inception? Is that the one with
Leonardo DiCaprio? Yeah.
Yep, that was a good one. Of course, Interstellar, one of my favorite movies.
Oh, great!
Yeah, that was great. And he did some of the Batmans, which were great.
Yes, and Dunkirk. Dunkirk is phenomenal.
Yep. And of course, if you like time movies, watch Tenet. It'll take you 3 times to figure out what's going on, but it's worth watching it every single time. Tenet, T-E-N-N-E-T.
Yeah, that was good. By the way, in Oppenheimer, did you catch, it took me a while, and I realized what he was doing. It was in black and white when it was from Robert Downey's character's perspective, and it was color when it was from Oppenheimer's perspective.
Yeah, I had read that before I went in, so I was prepared for that. Yes.
Yeah.
Yeah.
Okay. So there you go. You got plenty of movies, plenty of stuff, and I gave a couple of books out too.
There you go.
All right, Jay, that's it. What's our wager again? What did I say? We get to 5,400 before 4,900. Is that right?
I think I said 48, which looks
48
less likely every day, but that's okay. Yeah.
All right. None of us has gotten there yet. All right, everyone. That's it.
Thank you, Barry. Bye.
Take care.